it is still in a downtrend. So a logical point for the stop would be to place it up here, because at that point then you're definitely wrong and the trend has shifted back to the upside. So in this particular case, you can see that the market made a move. Granted, you would have had to suffer through some pretty heavy duty, in some cases, retracements. Let's take a look at this. Almost 30 pips there and 18 pips here. But in the end, at this point, 30 pips worth of profit. Okay, so the original loss has been made up, and you're 10 pips to the good, almost. And then you can see the market continues to flow to the downside. And now, let's see, holding on to 84. Let me just get to current trading. So 104 points on the day. So again, this is why trading on these low time frames can be very difficult psychologically, because you've got to take the initial loss, and then you have to sit through a 30 pip retracement and a 20 pip retracement before the market finally does break in your favor. And some days you may not get that. Some days, you're going to have the market triggering you long, triggering you short, triggering you out, and then doing nothing. Okay? You have got to realize that not all days are going to give you these kinds of easy profits. Okay, so let's take a look at a couple more examples. I'll actually move up to a 15-minute, bring in some more data so we can go back in time. Okay, so now we're looking at a 15-minute bar, and we've gone back in time a little bit. And this gives us a really good example of some of the finer points of this whole concept of the weave. Okay, you can see that this area in the middle of the screen is giving us an overall weave. Okay, so you see the market cross, cross, cross. Okay, this would be a weave. Okay, the weave doesn't have to be where the moving averages, look like this, and then you just see them kind of merge together. It doesn't have to be so flat. You can also have the weave where the moving averages cross, cross, cross like this, where it's very, very quick. Now the key here, and I don't want to get into a whole bunch of discussions about what are the exceptions and how to tell this and that. The absolute best suggestion that I can give you as an individual trader is, if you don't know, don't go. If you're confused about, is this a weave or is this not a weave, don't trade. You need to be personally responsible for your trade, which means if you're looking at the market in this area and you just can't make up your mind, you can't decide on whether or not this is the weave, and I haven't put out a video or I haven't highlighted it, don't trade. Don't be in such a hurry to make money that you start making foolish decisions. Okay? So we do have a weave. Let's kind of zoom in here, and we'll take a look at this thing as it develops. And we don't want to zoom in too much. Okay, so we'll go back a few bars. You can see here that the moving averages are separate. The market looked like it might be starting a weave here, but then boom, the moving averages separate. Moving averages separate here. You know right now that it's going to take a little while for a weave to form.